Hi, it's Ricky from Graham Tax and Accounting. I'm going to talk today about a question that's frequently asked from my corporate owners, which is how much money should I pay out of my corporation? This question, it gets asked throughout the year, but where it really comes into play and is really important is at the end of the year, once you know exactly how much your business has made and what your year has looked like. Now, on an absolute level, if you want to pay the minimum amount of taxes, the recommendation would be to just keep as much money in the corporation as possible. You're going to usually pay that 12% small business tax rate, which is lower than any personal tax rate that is currently out there, even on the lowest incomes. Just keep the money within the corporation, and then you just pay your corporate tax rate of around 12%. Working with an accountant, what we usually do is we understand what your current year looks like, what your next year looks like, and then also potentially what 2 years out looks like. And we ask you what your financial goals are as well too. Let's say over 2 years, you're gonna pay yourself out $100,000 per year. What you don't want is to have 1 year you just pay yourself $25,000, and then the next year you pay yourself $175,000. At the end of the day, over those 2 years, you're still claiming $200,000, but in the latter example where you have that 1 year of $175,000, you're gonna pay a much substantially higher tax rate, almost 50% in personal tax rates, as opposed to if you had just declared $100,000 in 1 year and then $100,000 in the other year, you're gonna actually be in a much lower tax rate, in the low 40s. You're gonna wanna make a game plan with your accountant to make sure that this meets your goals and your objectives. As a corporation, you have some tools in your toolbox, one of them being a shareholder loan. As a shareholder of the corporation, you're actually able to withdraw money out of your corporation on a tax-free basis, and as long as that money gets paid back within a year of your year end, then you don't actually have to pay any taxes. Let's take that $200,000 example over 2 years again. Let's say you need a little bit more money in this current year, and then in the following year, let's say you're buying a car or something, and you need an additional $25,000 for this year. So you need $125,000. So what we could potentially do is we take a loan from the corporation for $25,000 in this current year, and then you declare only $100,000 in income. You pay personal income tax on that $100,000, and then in the next year, you have that loan sitting on your books, and then instead of actually repaying it, we're just gonna say, you know what, we're gonna declare that income. So in the next year, we're only gonna actually pay out $75,000, let's call it, but because we're not reimbursing the corporation for that $25,000, that's gonna go into your personal income. So you've effectively only declared $100,000 in both years, but you were able to move around the actual timing of the payments without any adverse tax consequences and moving yourself up into a potentially higher tax bracket. All of this is a little bit complex, which is the reason why I always recommend, if you really want to be efficient and be able to really plan best, do it with an accountant. We see this day in, day out. We do this for all of our clients, big and small. We're going to be able to just give you peace of mind. Don't just do what you did last year. Talk to the accountant, make sure he or she understands your personal situation and if any things have changed, and then they'll create an appropriate plan that's going to help you minimize your taxes.